Realty Income is down 22% over the last year, now trading at $52, and this looks to be a massive opportunity with their earnings being released next week. This is a hugely undervalued company, and in today's episode we're going to take a look at what the expectations are for Realty Income next week. We're going to talk about a deal which got slipped under the net that not a lot of people are talking about, a huge deal for Realty Income and Decathlon. We're going to take a look at their dividend safety. We're going to take a look at some very important financial metrics, and we're going to see what the expectation is for their revenue increase from 2022 to 2023, both on the top line as well as the bottom line. We're also going to see how well this company is, the health in terms of their total cash versus their total debt. Are there any worries of any potential implications to the dividend? And we'll see how strong this company has performed, not just over the last few years, but also versus their competitors. We're going to talk about the institutions who have been buying a lot of shares over the last few months, and we'll very briefly talk about Larry Chapman, who has been selling a number of shares of Realty Income, a director within the business. And don't forget, we will run it through the valuation model, getting to our intrinsic value, getting to our acceptable buy price given our investor margin of safety, and we'll look towards Wall Street to see what they're forecasting over the next 12 months. So we can start off with the historical performance of Realty Income, now down 22% over the last year. However, when we extend it to the last 10 years, they are up 24%. Granted, it doesn't include those dividends reinvested, but it isn't the greatest return on your investment, and we can see they did peak just before the pandemic around that $80 mark in February 2020. Now, they are trading towards the lower end of the 52-week range. The yield is just below 6%, and they have a P to FFO of 12.65. Now, before we look at the expectations, we can just very quickly look at their total revenues. Now, from 2018 to 2022, what we expect is 5 to 10% increase year on year. In actual fact, we see it more than double from 1.3 billion to 3.3, and it's nice to note those consistent increases year on year. We'll also talk about the adjusted funds from operation per share growth, which is important for REITs. Now, December 2023, we're expecting a nice jump from 2022's 3.3 billion to 3.9 billion. So that top line is expected to see some very nice continued increase, similar to what we've seen over the last few years. Bottom line, a similar story, 364 million reported in 2018, 870 in 2022, and we can see again an increase expected to their bottom line in 2023. We do note some inconsistencies. For example, 2018's bottom line increased to 2019 before decreasing to 2021. It did then pick up in 22 and again is expected to pick up in 2023. So overall, the income statement is looking positive, and we are expecting some nice numbers to their top line and bottom line for 2023's full year. Quick health check then. Total cash versus total debt. It has gone from around 10 million in 2018 to 344 million from their last quarterly report. So they do hold 34 times more cash than they did 5 years ago. But again, it's important to understand that when we do look at the total debt, this is slightly different for REITs, as this number does continue to increase as they are trying to expand. So total debt, as we can see here, has gone from 6.5 billion in 2018 to 21 billion. And we'll talk about the net debt to EBITDA, which does directly impact that dividend shortly. In terms of how they've performed, well, look, over the last year, they are down 17%. Now, this includes reinvesting those dividends. They have been outperformed by other competitors. We have Simon Property Group, we have Kimco Realty, as well as a few well-known others that we can see here. Now, when we expand that over the last 5 years, we do see, whilst they're not one of the worst performing, they are still negative 3.28%. In actual fact, we see Kimco Realty up 39%. So not only has Realty Income performed very poorly, but even the best in the industry, Kimco, is only up 39%. Always remember though, past performance isn't an indicator of future performance. Institutional ownership sits just below 80%. Now, around 2 billion worth of shares have been sold by these institutions. But as we can see, over the last 12 months, a lot more buying. And notably in Q4, we saw around 1.85 billion worth of shares being bought, as opposed to 285 million worth sold. Do remember, though, it is important, institutional investors buying or selling, always do your own due diligence and never copy what they do. Very quickly then, insider buying, insider selling. As always, insider buying very bullish. We expect management to buy shares because they believe the share price will go up. Insider selling, less bearish due to the fact that they sell for many reasons, whether that's personal or financial. Just pointing out, Larry Chapman, now this was in December, so a couple of months ago, sold around 3,500 shares for $200,000. Since then, though, the share price has dropped by around 8%. Always take this with a pinch of salt, especially insider selling. And always, as we mentioned, it is important, do your own due diligence. Now, before we do touch upon that dividend safety, let's jump onto that news. Now, for those that don't know, Decathlon is essentially a European sports company. And as we can see here, their portfolio includes properties in Germany, France, Spain and Portugal. And they are, as we mentioned, one of the leading sports companies and sporting good retailers. So very popular to note that we can see Realty Income announce a 527 million inaugural plan of European sale and leaseback with Decathlon. So very, very positive news. It wasn't something that has been talked about, but something we did want to mention as it's something that was brought to our attention fairly recently. Now moving on to expectations by the analysts for Realty Income in their earnings next week. A few things firstly to note, they are expecting that their current quarter have a 2+ percentage point increase from a year ago quarter, so some nice growth, and they are expecting the full year to be a plus 2.3% increase year over year. On top of that, they are expecting even greater increase for next year, plus 4.7%. Do bear in mind, this will essentially include that merger with Spirit Realty Corporation, so hopefully we should see some nice synergies between the two companies. And when looking at their revenue forward looking as well as the current year, we can see that they are indicating a change of plus 18.3%, very, very positive. And when looking out to the next few years, they're indicating plus 21% and plus 14.5% respectively. So the industry analysts are expecting a lot of positive news from Realty Income's earnings and from the next few years. Again, let's hopefully see that Spirit Realty merger come into fruition in terms of lots of synergies. Now, dividend safety score, we can see it sits at 80. It is safe. Market cap 38 billion. It is a large cap company. Now, in terms of those recessionary metrics, for those that see a recession inbound, well, they increased the dividend during the last recession. They had above average growth, -1% versus the S&P's -12. And we can see they marginally outperformed the S&P, -43% return versus the S&P's -55. Dividend growth, what we always indicate on the channel and advocate, 4% as a minimum just to keep up in line with inflation. They managed that over the last full year, slightly lower over the last 5 years, but over the last 20 years, very positive to note that 5%. Realty Income are also a dividend aristocrat. They have been increasing those dividends consecutively for the last 25 years or more. And when we analyze dividend yield theory, for those that are new, it states the company is undervalued when the current yield sits above the 5-year average, 5.88 versus 4.43. So we see our first sign of undervaluation. Do bear in mind we don't look at any of these models in isolation. We will conclude towards the end of the episode. Forward P to FFO 12.6 versus the 5-year average of 17.8. Again, another sign of undervaluation. And we note the real estate sector P to FFO 13.7, slightly higher than Realty Income's 12.6. Now, typically on the channel, we focus on the free cash flow payout. However, for REITs, it is a lot more volatile. So we draw your attention to the adjusted FFO, funds from operation payout. We want to see below 90% for REITs as a general blanket rule. Nice to note from Realty Income from 2013 where it was 90%, it has been decreasing. 76% in 22, 76 in 2023, 74 expected in 2024. Very nice to note it is well below that 90%. Adjusted funds from operation as well, nice consistent increases, 241 to 392, expecting around 4 in 2023's report, and expecting an increase to 415 in 2024. So it is nice to note those increases. We can see the adjusted funds from operation per share growth, which is very important for REITs. 2023 and 2024 at 3 to 4% isn't too bad. And when we look at the top line growth for REITs, what we're aiming for here is steady moderate growth, 5 to 10%. 2021, 2022 and 2023, very, very strong increases to that top line. And we are expecting, as we just ran through, that to continue. Then numerically, for those that prefer to see the numbers, 780 million to 3.9 billion expected. Now, shares outstanding, we love it when companies do share buybacks, returning excess cash to investor pockets. For REITs, unfortunately, it is very typical to see the opposite, where they dilute your position. 192 million in 2013, 670 in 2023. The reason for this is they do this, as we mentioned earlier, to fund their property acquisitions, as they do retain a little of that internally generated cash flow after paying out their dividends. Now, we have just released our latest free weekly newsletter discussing share buybacks, running through, in fact, companies that buy a lot of shares aggressively. These are the type of companies you want on your watch list. Completely free. If you want to sign up, click on that pinned comment below. We also have many different articles which are all free to access, notably one where we run through our 7 golden dividend metrics, discussing our undervalued screener to find those companies. So moving on then, we get to the ROIC. Now, return on invested capital. We want to see 10% or more for typical companies, 3 to 5% for REITs. So for Realty Income, it is pretty much around that borderline level, 3% in 2022. So not too bad, something we can accept. Ideally, we will see it back at the 4% that we have consistently seen for the company. Operating margin, nice to note, around the 30 to 40%. In fact, it did drop in 2022, but we should expect that back up into the 40s in 2023. Finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us two things. Remember, firstly, the dividend safety. Secondly, the balance sheet strength. For REITs, we want to see below 5.5. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Way too high in 2021. High in 2022. Now 2023 at 5.97 is still quite high. The benefit here is to note that in 2024 it is expected to come down to 4.57, which is a lot better. That dividend should be a lot safer, and it's a lot healthier for the company, and the balance sheet will end up being stronger. So let's jump into the valuation of Realty Income. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now let's jump into the first model. Now typically we'd use the Graham's valuation. For REITs though, they are not relevant. So the first model here is the multiples valuation model. Companies in a similar sector and size that we analyze, we have the average P to FO, compare that to Realty Incomes and their EPS. We get an intrinsic value of $63. We have our first sign of undervaluation, although do bear in mind we don't look at any of these models in isolation. We then have the dividend discount model with the average growth around 3.14% over the last few years. We've gone pretty much in line with that, although we do expect it to be around 4%, so we've gone more conservative. Again, another sign of undervaluation, $67 versus the market value. We then move on to the DCF model with the free cash flow year on year. Average growth 22%. We've gone much lower and lower than analyst estimates, again to be conservative. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. Another sign of undervaluation. So the intrinsic model here for Realty Income is the average of these three models. And as always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list, do click on that pinned comment below. Margin of safety then, we start off with 10%, which is what we use if it meets three criteria: wide moat, strong financial metrics, good forward-looking data. It is an acceptable buy up to $59 if you're satisfied with a 10% margin of safety. At 15%, a buy up to $55, and we keep going till it's near the current trading price, and we can see 10 cents shy from $52. So right now we see a 20% margin of safety on Realty Income. Those who are looking for a larger margin of safety at 25%, it would be around $48, $49, and those looking at 30%, it would be around $45. So right now, as we mentioned, a 20% margin of safety for Realty Income. In terms of Wall Street and what they forecast, well, they see upside of 19%. They do see this as a strong buy with a price target of $62. Now, Realty Income is one that I do have in my portfolio. It is one that I have been adding fairly regularly, and around the $52 mark that it is one where I will continue to add. And if it starts to go lower into the 40s, then I will add a lot more aggressively. Right now, though, at a 20% margin of safety, I do feel it is fairly strong for a buy. But again, a lot of people may be expecting this to dip down into the 40s. But it will be interesting to see how the earnings are on Thursday, as this could go up quite significantly. But then again, if you do consider the rate cuts, until we start to see the first few rate cuts, which are now not expected until Q3 of 2024, then the REITs as a whole, the industry, may be suppressed in terms of share price until we see those come to fruition. As always, let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you'll continue notified of these videos as they drop. And as always, have a great day and see you on the next one.